Based on these images, I'll provide a comprehensive explanation of this institutional trading strategy that combines multiple smart money concepts. Core strategy overview. This is an institutional order flow strategy that identifies where large players, banks, hedge funds, have placed their orders and trades alongside them rather than against retail sentiment. Key components explained. 1. Order blocks. OB. What they are. Zones where institutions have placed large buy, sell orders that weren't completely filled, creating imbalances in the market. How to identify. Look for the last bullish candle before a strong bearish move, bullish OB. Look for the last bearish candle before a strong bullish move, bearish OB. These represent areas where smart money has unfinished business. The logic. Institutions can't fill massive orders all at once without moving the market against them, so they leave portions unfilled. When price returns to these levels, they complete their positions. 2. Fair value gaps, FVG. What they are. Price imbalances where the market moved so quickly that trading was inefficient, leaving gaps that need to be filled. Identification. 3 consecutive candles where the high of candle 1 doesn't overlap with the low of candle 3. Creates an unfilled price zone that acts as a magnet for future price action. 3. Liquidity concepts. The strategy focuses on liquidity grabs, moments when price briefly moves beyond key levels to trigger stop losses of retail traders. Activate pending orders. Clear out weak hands before the real institutional move begins. Key insight. The text explains that inefficiency represents areas where orders were left unfilled, meaning these zones will likely be revisited. 4. Support and resistance integration. The images show how order blocks work in conjunction with traditional S&R. Resistance zones become areas where sell orders accumulate. Support zones become areas where buy orders accumulate. The combination of both creates higher probability setups. 5. Rejection blocks. These are areas where price was strongly rejected, indicated by long wicks. They represent zones where one side, buyers or sellers, overwhelmed the other, creating future reversal zones. Trading execution strategy. Entry signals. Structure break. Wait for price to break a significant high, low. Retest. Price returns to the order block that caused the break. Rejection. Look for rejection from the OB zone, shown by the arrows in the images. Confluence. Best setups occur where OB aligns with S&R levels. The process. Identify the OB. Find zones where institutions left unfilled orders. Wait for liquidity grab. Price moves beyond the zone to clear stops. Enter on return. When price comes back to the OB zone. Target opposite levels. Take profits at the next OB or S&R level. Risk management. Place stops beyond the liquidity zone, where stops were grabbed. Risk-reward ratios typically 1 to 2 or better. Only trade when multiple factors align. Why this works. Market structure logic. The strategy recognizes that large institutions move markets, not retail traders. Institutions leave footprints, order blocks, that can be identified. Price always returns to areas of inefficiency.